Hey, this is Sasha. Welcome to another episode here on Hungry for Returns. Today we are doing another Q&A session and we have questions coming in. And if you have a question, you can submit a question by voice at tradersfly.com and then submit a voice question. And that way I can answer your question with a video. All right, so let's get started. Let's listen to the question and then we'll go ahead and answer it on screen.
Hello, Sasha. This is Rob. Just came up with a follow-up question sort of based on a video that was posted on August 28th, 18, regarding day trading options in, at, or out of the money. Great info, by the way. I'm also curious to see if you can elaborate on the choice of expiration date. If I'm really concerned with the price movement throughout the course of the day, can't I just enter with a small amount of capital on something that expires, let's say, like 5 to 10 days from now? Here's my concern. I don't want to pay for more time value that I don't necessarily need. I'd rather sell them back to the market before time decay kicks in anymore. I've had great success with this on like 5 to 6 occasions. Of course, only entering if that bid-ask spread is favorable. But I do find that I tend to lose that money if I keep those positions overnight, presumably due to time decay or just like the volatility swinging up and down. So I assume in this case I would be trading at or in the money. Any pointers you could suggest on that expiration would be helpful. I'm still kind of new to this, but this volatility is kind of telling me that I need to be able to trade a little bit more in both directions instead of just like waiting on the sidelines for my long calls to bounce back if I get caught in a directional change. So, like I said, this is the first time I've seen the market this volatile, so I might be in the clouds a little bit. I'm not sure if that's a good strategy, especially once things start to settle down a little bit. So let me know if you have any suggestions. Thank you.
All right. There's a lot in that question. So let's summarize it here real quick. Basically, we're looking to day trade options. There's a couple ways to do it. Typically, most people do it, buy a call, sell a call, buy a put, sell a put. Doing single individuals based on movement of the stock price. Now, that's one way to do day trading options. Another way to do it is also to do it with short-term duration, but really capitalize on theta decay. So I'm going to show you the first way, which is kind of the question that was asked. And really the whole point is what Rob was getting at was that basically, okay, let's just trade these options, 7-day, 14-day options, rather than day trading kind of these options 84 days out or 120 days out or even 40 days out, because you have to pay more. These cost more, but the trade-off is less time decay. Now, these up here cost less, but fast time decay. So that's kind of the trade-off that you have to deal with. And typically, if you're just day trading, let's just say I'm day trading Google, I'll go with a 7-day option. And if I do a 7-day and I'll go to the 140, let's say I'm looking for it to go to the downside just because the put is out of the money right here. I'll go ahead buy a single. Well, that single costs me $1,280. Now, if I do that same thing, let's say going into August, all of a sudden that single costs me $5,000 because you're paying for more time premium. So what he's getting at is, why do I really need to go to August? I don't need to pay for more time premium. And you don't have to. You could go with a shorter time premium. But the problem is you're losing 100 a day. Well, 77 in this case. You're losing $77 per day if you're going into May. And if you're going into, let's say, March, you're only losing 13 per day. So if it was a 3-day trade or 4-day trade, you're not losing as much. So you could go ahead and do shorter term duration trades. However, you have to keep in mind this delta factor, right? So in this case, you have, if you're capitalizing on the movement, the delta here is negative 43. If we go to kind of May, you got negative 47. If you really want to bump up your delta, I mean, because you're making money from the movement of the stock, the better approach is to go deep in the money. In this case, for our put side, we'll go ahead and let's just say 1200 on the put side. Okay, so now I can ramp that delta up to almost be exactly like the stock. So you can see here, it doesn't have the other line at the moment, but really what you're doing here is you're increasing on in the money, so that way your delta is as close to, let's say if we go to June, if it'll have it, it's as close as possible, here you go, to almost 100 shares, because you're controlling 100 shares with a call or a single put. And now you're getting almost 85% of that move. So $85 per $1 move in the stock. So if you're trying to get as close as possible to the stock, you have to go deep in the money on that direction. If you were to do kind of a call, it's kind of the opposite, right? So here it's only 14 delta. And then if you really want to go deep kind of in the money, let's just go to 1050. Now you're getting 92. So you're really going 1-to-1. And the thing is when you're trading options on a day trade basis, the issue you have is that theta decay. Now you can actually use that to your advantage. Let's go to version number 2 of day trading. So can you do this? Yeah, you can, but you have, of course, a theta problem. That's the biggest issue that you have, is the theta problem, because you're a buyer of an option and it's a shorter term duration. So that's your biggest kind of concern. You do have some vega there as well, but really you're trying to make sure that that delta is high enough, way above your theta and way above your vega, so that way you make money on the movement. Let's go to version number 2. So here's another way to day trade options, also to go kind of 7-14 days out. So if I go ahead and do, let's take a calendar spread here, and I kind of do an inverse of this. I'll go right at the money, doesn't matter, call or put. Go right at the money, and I'll go, one will be about 7 days out, and this is a weekly, and the other will be about 14 days after that. So I'll go maybe to June 21st. Okay, so we'll go to June 21st, about 2 weeks out. So now look at this. Well, now I'm capitalizing on that theta. The theta is super high. So when would I want to do this? Well, it's when the volatilities are really crazy, because what happens is this theta is so high relative to my vega. So you can see here in 1 to 2 days, I can make up a vega problem, volatility problem. So in, let's just say 3-4 days later, my theta is even higher than my vega. And that's kind of when you would want to put on trades like this. Now, normally, let's say a calendar trade, you'll do kind of a 28-day trade. And let's just do 50 strikes. And let's do the same kind of concept by a calendar. Okay, and we'll go the next one kind of July 19th. This is kind of a typical calendar that you may do. But now look how many theta to your vega ratio. It's about 4 times the difference. So it takes 4 days to make it up. When you look at a shorter term duration, it's a 1-to-2 ratio. It only takes 2 days. 4 days versus 2 days. So you can see your theta will knock out your vega, and that vega is not going to hurt you as badly. It can still hurt you, but it's not as bad as the longer term duration. This is when volatilities are a little crazy. You might want to go shorter term duration because your theta is doing the work for you. Other times with longer term durations, your vega might be doing the work for you in a lot of instances because it is a bigger Greek. So in here, it's a whole different approach. And this is another way to day trade options, because now, a couple days into it, you're already up, let's say $180 3 days into it, and $170 on $1,500 is 10%. If I'm doing a single right here, okay, so maybe that stock goes up, and yeah, you might be able to make, let's say, $4,200 on $9,600, 50%. But in this case, if a stock doesn't move, you lose. If a stock goes against you, you lose. The only way you make money is if it explodes. Even if it goes up a little bit, you still are losing on the theta. Whereas a shorter term approach on, let's say, a calendar, it could be a butterfly, it could be something else, an iron condor. Anyway, shorter term duration here, you have a much higher theta. Well, here, if it stands still, you win. If it moves up a little bit, you win. Moves down a little bit, you win. If it moves up a lot, that's when you lose. If it moves down a lot, that's when you lose. So you have much more win-loss chances or situations here, a much favorable situation than you do maybe on the single. But of course, the single you make a little bit more, but is that extra percentage worth the trade-off? That's something you have to decide. Risk management, right? So anyways, I hope this makes sense. Really, 2 ways to kind of day trade options. One way, really deep in the money, because your delta is just so high, and then you're looking for a directional move. The other way is shorter term durations, and that way you burn that theta real quick, collecting that theta, collecting that premium as a seller. That would be kind of the basics. Of course, there's other ways to do some day trading, doing gamma scalping, theta scalping, those kinds of things, but those are way advanced beyond the scope of a YouTube kind of thing. So anyways, thank you so much for joining me. Hope you enjoyed this video, and if you have a specific question that you want me answered, go to our website, tradersfly.com, submit a question by voice, and you might be featured on the show. But if not, you just want to hang out on YouTube, subscribe to the YouTube channel, and of course, get on the newsletter list, because if you're not on the newsletter list, you don't know when I'm going to release a new course. You might not know when there's a coupon. You might not know when we're doing a good webinar. So get on the newsletter list. Thanks for joining me, and I'll see you next time.